What if the most expensive investing mistake you make this year is following the oldest piece of Wall Street advice? This chart shows a flat summer trading period that suddenly rips upward by a massive 16%. It is a hidden rally that investors who blindly sell their stocks in May miss entirely. By the end of this video, we are going to look at the exact post-election data anomaly that exposes this myth, and the precise three-step strategy you need to catch the upside. To understand why this trap works so well, we must look at where the phrase originates. It started in 1800s London with the saying, "Sell in May and go away, come back on St. Leger's Day." Wealthy brokers would simply abandon the city for the summer. The markets went quiet because the traders were literally on vacation, not because the underlying economy was failing. The saying sounds safe, and it rhymes perfectly. But trusting your modern wealth today to a 19th century vacation schedule is a highly dangerous way to invest. This chart tracks historical S&P 500 returns. Winter months average a strong 7% gain. Summer drops to about 2%. But since 1990, the summer average climbs to 3%. In fact, May closed positive in 12 of the last 13 years. Data from JP Morgan proves that if you miss just a handful of the market's absolute best days, you completely destroy your portfolio's long-term returns. And those specific high-growth days almost always trigger during periods of extreme panic. Right after the historic capitulation in March 2020, the S&P 500 exploded upward by more than 60% in a matter of months. If you sit in cash waiting for clear skies and economic certainty, you mathematically guarantee that you will miss the steepest, most profitable segment of the recovery. We are wired for loss aversion. The psychological pain of losing money is so severe that it forces us to panic and hit the sell button during minor, everyday dips. You sell your positions on a minor 2% pullback in May. You watch from the sidelines as an 18% summer rally takes off without you. And the resulting fear of missing out forces you to buy back in at the absolute top of the market. So why do financial media outlets and massive hedge funds actively pump out these terrifying summer narratives every single spring? They need volume. By pushing the sell in May narrative, they generate retail panic. That fear creates the exact cheap liquidity institutions need to aggressively accumulate high-growth tech stocks at a truly massive summer discount. It operates entirely as an institutional smokescreen, designed specifically to harvest assets from emotional retail investors. Which brings us to the specific anomaly I mentioned earlier. The single most powerful counter-indicator to the summer slump is the midterm election cycle. This timeline maps CFRA research data showing that from October 31st of a midterm year to the following year, the S&P 500 has never declined, not once. It posts an average price gain of 16%, resulting in a total return of roughly 20%. Stocks surge during these specific windows because policy uncertainty naturally clears out once the election results are settled. If you liquidate your portfolio in May during a midterm cycle, you are voluntarily stepping away right before the most statistically powerful compounding setup on the calendar. Instead of retreating to cash, execute the May rotation. Shift your capital into defensive growth and high free cash flow equities that actually thrive on lower volume. Next, use market volatility as a tool. Set your dollar cost averaging to automatically trigger during the historically soft windows of mid-June and August. Finally, ignore the calendar rhymes. Track the true market environment by watching global central bank liquidity. In modern investing, experiencing a temporary portfolio drop is not the most severe threat to your wealth. The true danger is sitting entirely in cash when the next unexpected rally violently begins. And there is a massive Federal Reserve catalyst about to trigger the next move. Click the video on your screen right now to see the data on that exact event, and I'll see you there.